Welcome to the debate. So right now, for every 100 ounces of silver traded on paper,
Yeah.
only about 13 actual physical ounces are sitting in a vault to back it up.
Which sounds pretty wild, right?
It is wild. I mean, for decades, the major bullion banks have used this fractional system to just completely dominate the market. They expand the paper supply way beyond the physical reality.
Sure.
But on June 30th, this new global banking rule kicks in, and it fundamentally breaks the math behind that entire system.
Okay, look, the system is undeniably under stress. I'll give you that. But framing a 13% coverage ratio as this existential crisis, it ignores the basic plumbing of how commodity exchanges actually work.
Well, we are going to test that plumbing today because we're looking at the global silver market as it crashes head-on into the new Basel III regulations.
Right, specifically the net stable funding ratio, or NSFR.
Exactly. Which is basically just a strict new rule that demands banks hold a lot more real cash to back up their paper silver bets.
Yeah, the unallocated positions.
Right. And at the exact same time, the physical market is in its sixth straight year of global supply shortages. There are less than 80 million ounces left in the official global warehouses.
The tension is real, but the outcome is where we completely diverge. Just because the physical market is tight and there's a new rule coming, doesn't mean we're about to see a chaotic, market-breaking explosion.
And that really is the central question we are exploring today. Does this convergence, this totally empty physical market hitting strict new banking rules, guarantee a massive, historic price squeeze?
Or, does that whole apocalyptic story just misunderstand how banks manage risk?
Right. So I'm taking the position that the data proves an unavoidable structural break. The math of having zero physical silver mixed with rules that punish paper silver will force a historic price surge.
And I argue that the market mechanics, the exchange rules, the bank's flexibility will allow a smooth transition. I mean, these banks aren't just passive victims tied to a train track, right? They are actively fixing the problem as we speak.
Well, let's get right into the mechanics of why this time is actually different. The big banks hold these massive things called legacy shorts.
Right. And we should clarify, they didn't build these short bets just because they're like cartoon villains trying to crash the price.
No, of course not. They do it to act as middlemen. They hedge the price for the actual silver miners.
Exactly.
But under the old rules, holding paper silver, so silver that isn't actually a real physical bar with your name on it, was treated as super safe. It was basically as good as cash.
Right, a highly liquid asset. But Basel III flips that.
It completely flips it.
Yeah, it changes the risk weighting. So under the new NSFR guidelines, unallocated paper silver needs an 85% funding factor.
Which means, in simple English, the banks have to lock up massive piles of their own expensive cash just to hold these paper promises.
Right. It gets very expensive.
So those old standard market-making bets suddenly turn into toxic, giant liabilities. And, this is happening right when the physical market is structurally broken.
Broken is a strong word.
I mean, 6 years of missing silver. Industrial demand is off the charts. People in India and China are buying it up like crazy. They are pulling real metal out of the system at a record pace.
Yeah. The physical deficit is a serious fundamental issue. I'm not denying that. 6 years of draining the stockpiles definitely changes the baseline.
Exactly. The physical supply just isn't there to cover the paper promises. And the smart money knows the math is busted.
But, okay, hold on. Your whole argument assumes that a new bank fee basically equals a guaranteed short squeeze.
It does when there's no metal.
You're looking at that June 30th deadline like it's a cliff edge. And I think that just really underestimates the sophistication of these huge financial giants.
Sophistication or not, math is math.
Let's look at the actual data from our source material, though. Look at the managed money shorts. So these are the big hedge funds and the speculative traders, right?
Yeah.
Their short bets against silver have plummeted by an astounding 77%.
Right. And you view that as, what, a pressure release valve?
I view it as absolute proof that the banks are already fixing the problem. I mean, think about the mechanics here. What does a 77% drop actually mean?
It means they are running for the exits.
To exit a short bet, you have to buy silver contracts. If those positions have already dropped by 77%,
The massive wave of panic buying you're predicting, it already happened.
Wait, no.
The trap is mostly empty. A historic squeeze requires people to be trapped and forced to buy all at once. The data literally tells us the speculators already quietly left the room.
Okay, you're looking at that drop as a victory, but you have the mechanics completely backward.
How so?
You're assuming they exited by actually finding real silver, or by perfectly balancing their books.
They bought back their contracts.
Right. But what actually happens in these markets is they exit by passing the bag to the big banks that are still stuck. It's like a massive game of musical chairs.
The game of musical chairs?
Yeah. That 77% drop just means the music started to slow down and the speculators grabbed the easy paper chairs.
Mm-hmm.
The guys left standing are the core bullion banks. They still hold the massive legacy bets. The speculators running away just removes the buffer.
Well, passing the bag implies the total number of bets stayed exactly the same. But the sheer size of the drop shows that positions are actually being deleted. They are netting out. The market is shrinking its total debt.
It is shrinking its debt in a room where the oxygen has already run out.
Oh, come on.
No, seriously, let's look at the physical reality backing those remaining bets. This brings us right back to that 13% coverage ratio.
Right. The 13 real ounces for every 100 paper ones.
Exactly. If the bullion banks need to get out of their old bets because Basel III makes them too expensive to hold, they have to buy.
Sure.
But they can't just trade paper back and forth endlessly if someone demands real physical delivery. And there are less than 80 million ounces left in the official registered global warehouses.
Okay, yes, a 13% coverage ratio is tight. I admit that. But you're assuming that every single paper contract will demand real physical delivery all on the same day.
They might, if the price starts moving.
That challenges the whole basis of how commodity exchanges work. They operate on fractional reserves all the time. It's totally normal.
They operate on fractional reserves until there is a physical run on the bank.
But a physical run requires people who actually want the heavy metal in their living rooms. The vast majority of people trading paper silver, algorithmic traders, pension funds, they don't want real silver.
Some of them don't, sure.
They are just trading the price tag. They don't have armored trucks. They don't have super secure vaults in London. They don't want to pay for insurance.
Okay, but
If the market gets too tight, the exchanges literally have rules in place to just pay people out in cash instead of metal. Problem solved.
wait. Run that scenario for me in the real world.
Gladly.
Because you are completely ignoring the massive shift in who is actually buying this metal today. We aren't just talking about fancy hedge funds in Manhattan anymore.
We're talking about industrial users.
Exactly. Massive industrial factories and Eastern sovereign wealth funds. Think about a giant solar panel factory in China.
Okay?
They need massive amounts of silver paste to build solar panels. It's non-negotiable. So if they buy a contract for real delivery and the exchange says, hey, sorry, we have no metal, here's some cash instead, what happens?
They take the cash and buy it elsewhere?
From where? The vaults are empty, and cash doesn't conduct electricity. Their multi-billion-dollar assembly line just shuts down.
Look, industrial users absolutely need the metal. Yes, and they will source it. But you are confusing the commercial factory market with the Wall Street derivative market.
They are fundamentally tied together.
Not entirely.
The price on Wall Street dictates the price of the physical metal. If the exchange forces cash on a factory that needs real silver, trust in the exchange instantly dies.
That's a bit dramatic.
It would split the market in two. You'd have a paper price of silver that means absolutely nothing and a real physical price of silver that is thousands of dollars higher.
Okay, a split is a possibility in an extreme crisis, sure. But a cash settlement is exactly how you prevent a total system collapse. It's a circuit breaker.
A circuit breaker that destroys the exchange.
Now, when physical supplies get that tight, the price naturally goes up. And what happens when the price goes up? It encourages people to sell.
Selling what?
The eligible silver. You mentioned there are 80 million ounces in registered vaults, meaning metal that is officially ready to be delivered today.
Right.
But there are hundreds of millions of ounces sitting in eligible private vaults. If the price spikes, people will unlock those private vaults and sell it into the official system.
Will they, though? I mean, really think about that. That eligible metal isn't just sitting there bored waiting for a good price. It is privately owned wealth.
Right.
It belongs to rich families and long-term investors who watch this 6-year shortage happen. Why on earth would they sell their real, physical metal back into a paper banking system that is literally imploding?
Because every asset has a price. If the bullion banks are forced to buy, they will just bid the price up and up until that private metal finally comes out of hiding.
And that is exactly what a historic price squeeze is. You just perfectly described the squeeze I'm talking about.
Wait, no,
They have to bid the price of the moon just to convince some rich guy to give up his physical bar, all to satisfy a new banking rule.
a price increase to bring out more silver is not the same thing as the uncontrolled, world-ending explosion you are describing.
It'll be pretty uncontrolled for the banks that have to buy it.
You are treating this June 30th Basel III deadline like a bomb wired to explode at midnight.
Because it is a hard deadline.
But in global finance, deadlines like this are rarely absolute cliff edges. They don't just catch the world's largest banks completely by surprise.
The regulations were planned for years, I'll give you that. But the insane physical shortage was not.
The shortage has been building for years too.
But the banks assumed they could manage it. They thought they could use their massive paper trading power to keep prices low while they slowly fix their books. But Eastern demand completely front-ran them.
India has imported a lot, yes.
A staggering amount over the last 12 months. The banks are now trapped. They have a strict legal deadline on one side and a completely empty vault on the other.
See, that story completely ignores the reality of how financial regulators work. Regulators and central banks have a huge history of extending deadlines.
So they'll just change the rules?
They grant temporary waivers, or they allow different ways to comply if the strict rule is going to break the system. If this penalty on unallocated silver threatens to crash the biggest banks, the regulators will just, massage the timeline.
Wow, that is a staggering admission.
Why?
Because your entire argument against a massive squeeze relies purely on the hope that global regulators will just quietly cheat their own rules at the last second to bail out banks that made bad bets.
It's not a bailout, it's regulatory flexibility to make sure the market keeps functioning.
Call it what you want, it's changing the rules.
But even without the regulators stepping in, the banks themselves have immense secret resources, off-balance sheet resources.
Like what?
They can negotiate private transfers of metal. They can trade derivatives privately, over the counter, where the exchange rules don't even apply.
Okay, but
The idea that a massive, global, Tier 1 bank will just sit there, tied to a bad bet, until it is mathematically destroyed by a lack of silver, it goes against everything we know about these guys. They are experts at managing risk.
risk management only works when the real item actually exists.
It does exist.
For decades, the banks were bigger than the physical market. They could use computer trading to push the price around. But when physical supply literally runs dry, when factories absolutely must have the raw material to build things, paper engineering stops working.
I'm not denying the tightness.
You cannot build an electric vehicle battery with a private over-the-counter paper derivative. You need the actual silver.
I don't dispute the physical tightness, okay? The metal is clearly moving from the west to the east, and warehouse levels are definitely dropping.
Right.
But the mechanism of the squeeze you're predicting requires this inflexible, blind panic. And my point is that the 77% drop in those speculative shorts proves the panic was already managed.
Managed by pushing the problem to the bullion banks.
The banks will use their cash, their exchange rules, and their private deals to absorb the rest of the problem. It will be volatile, sure, but it will be a managed transition, not a total break.
But how do you absorb the problem when simply holding the problem becomes a massive fee? That is the whole point of the new NSFR rule.
They restructure.
It's not just that they have to slowly fix it. It's that it literally costs them 85% in cash reserves just to do nothing.
I know what the rule is.
In a high interest rate world, locking up that much cash just to babysit a bad silver bet is financial suicide for a bank. They have to dump the position, but they can't dump it without buying, and they can't buy without spiking the price because the official vaults are totally empty.
They can just convert their paper unallocated positions into allocated physical positions.
Which requires buying the physical metal.
Not necessarily on the open market all at once.
You keep circling back to solutions that all require finding magical silver that does not exist right now. Converting a paper promise into a real physical bar means a bank has to go into the market, find a guy willing to sell, buy the bar, and stick it in a vault.
Yes.
If every big bank tries to do that before June 30th to avoid the new banking fee and there are only 80 million ounces available, the math demands a violent price explosion.
It requires buying, yes. But banks buy directly from refiners. They make long-term deals with mining companies. They even borrow metal from governments.
That doesn't fix today's shortage.
The open exchange, that 80 million ounces you keep bringing up, is just the visible tip of the iceberg. It's just a buffer. It's not the total amount of silver in the world.
But sourcing from refiners doesn't solve a deficit. A deficit means the refiners are already selling every single ounce they produce straight to the solar factories, just to meet daily demand.
There is always some flexibility.
There is no excess capacity to rebuild the bank savings. That 80 million ounces is the only highly liquid, ready-to-go metal left.
And that buffer is tight, which is exactly why clearing out the hedge funds, that 77% drop, was so important.
We're back to that?
Yes, because by getting the paper speculators out of the way early, the banks saved what little physical silver is left for their own needs. If everyone was trying to exit at the same time, yeah, I'd agree. Catastrophic break. But they timed it out. It's a phased reduction.
A phased reduction only works when you control the clock. Basel III is what controls the clock now.
We'll see if the regulators hold firm.
Well, let's summarize where we both stand so everyone listening has a clear picture. Because the mechanics we've talked about today are going to dictate the entire commodities market over the next few months.
Sounds good. Go for it.
My position is really rooted in the mathematical impossibility of the current market. The big banks have used a fractional, paper-heavy system for decades, but reality has finally caught up.
The physical deficit.
Right. We have a massive 6-year shortage of real silver, driven by factories and Eastern buyers. And now, this new Basel III rule makes it crazy expensive for banks to keep their old paper bets. They are forced to exit in a market where the vaults are effectively empty. That bottleneck mathematically guarantees a historic price surge.
And you know, my position relies on the adaptability of the system. Yes, the physical market is tight, but viewing June 30th as an apocalypse severely underestimates how these global giants operate.
Right.
The massive drop in speculative shorts prove they are already fixing the problem safely. The banks will use cash settlements, private deals, and their huge cash reserves to handle the transition. There will be bumps, sure, but the system will function without breaking.
I think it is really important, though, to highlight exactly where we actually agree. Because we both clearly agree that the silver market is undergoing unprecedented stress right now.
100%. The data from our source material is impossible to ignore. The 6-year deficit is a hard reality.
Yep.
And the massive movement of real metal into places like India and China, that is a permanent change in how the market works.
Absolutely. Silver is basically acting as the canary in the coal mine for the whole financial system. As these new Basel III rules force things to be more transparent, this fight between paper promises and physical reality is going to become very obvious to the public.
It really forces us to ask a much bigger question. What happens when decades of fancy Wall Street math suddenly slam into the hard, totally uncompromising limits of the physical world?
Exactly. You can print an infinite amount of paper contracts, but you cannot print a silver atom.
It's the ultimate stress test of the entire exchange system. And, I encourage everyone listening to look past the daily price ticker. Track the actual mechanics we broke down today.
Keep an eye on those registered vault numbers.
Watch the vault levels, monitor the Eastern import data, and pay close attention to how banks handle their paper silver as that June deadline hits.
We will leave it up to you, the listener, to decide how this specific collision resolves. Just remember that 13% coverage ratio and the 80 million ounces left trying to hold up an ocean of paper claims.
It's going to be an interesting summer.
Will the banks orchestrate a controlled, quiet transition, or are we about to witness the mathematical breaking point of a fractional market? Thank you for joining us on The Debate.